of the morning to ya. Welcome to the coolest place to be every Tuesday at noon Eastern. That was in respect to Happy St. Patty's Day. How's everybody doing today? We are going to dive right into our Ethicsverse MBA. So drop your LinkedIn URL in the chat. Your network is your net worth, all of that. You got to expand both of them. We're going to be giving away some books today. We're going to be giving away the one and only Mary Shirley's book, Level Up. These are still flying off the shelves. People love this book. It's always time to level up your program. There's always more you can do to improve your program. So drop your comments in the chat. I will try to get to those. I'm here by myself today. So write in bold, maybe. Write in all caps, and we will dive in. This Thursday, we are going through our annual benchmark report. You are not going to want to miss this. If I had a Mount Rushmore of compliance, it might just be, the one and only Ellen on there 4 times. And she's going to be joining us on Thursday to walk through the benchmark report. So you're not going to want to miss that. And for those of you who are thinking about third-party risk management this year, this is a huge risk that takes a ton of time, that you probably spend a bunch of time sorting through a bunch of false positives. A bunch of resources probably go to this thing because it's very important, but you kind of sometimes have egg on your face, or you get this bad reputation because you're slowing down the business. Well, we got that fixed for you. So we have a brand new platform that is really AI driven, that lets you configure all of your you can put your risk lens across it, run some really smart, really leverage AI and keep human in the loop on the steps that matter most. So for those of you who have filled out the form, thank you very much. We'll be sharing some screenshots throughout. But we have a form ready. If you would like to participate in the beta, we're starting to have conversations with folks, starting to show them the platform. And if you're interested in participating, no obligation, of course, but you are more than welcome to do so. And I also want to talk, so here's the QR code. We'll also try to drop that in the chat as well. Happy St. Patty's Day. If you're not wearing green, please go ahead and pinch yourself. And if you think you're dreaming, pinch yourself, because guess what? You're not. We're also talking a little bit about our smart disclosures platform. Our job is to crowdsource risk intelligence, get some more data to better direct our efforts toward the things that matter most. We can't do our jobs without human beings sharing risk intelligence with us. So our smart disclosures platform helps you do that at scale. So many different use cases that we're seeing people leverage this platform for. And the nice thing about it is it all feeds directly into your case management system. So everything in one spot. And you have to make better bets with your time. What got us here, I say this all the time, what got us here is not going to get us there. So we have to elevate our programs. We have to wink, wink, level up our programs, and we have to take it to the next level. There's so much risk that's happening inside of our organizations, and when we are viewed inside of our organizations as a as a cost center, as the anti-business department, it's hard for us to really kind of get the traction we need to do our job in the best way possible. So we're going to be talking about that some more today. We had such a tremendous positive feedback, by the way, for the first session. Here is me again, the professor. I feel like such a professor. I've been lecturing my children, which they've loved over the last weeks. I'm really settling into this new role as professor. But so much great feedback from the first session. For this first section, we're doing 6 different episodes or 6 different classes for the Ethicsverse MBA. And we're going to continue to do this based on feedback that we get. So if you like these sessions, please share it in the chat. We're trying to spread the word about it. This is really the number one thing we can do to elevate ourselves within our organization. Show up like business people, show up speaking speaking the language of business, and positioning ourselves as these trusted advisors, this ever elusive trusted advisor moniker that we are trying to live out every single day. So today's session 2 of 6 in this first, chunk of Ethicsverse MBA courses is all about financial literacy you can't fake. So we're going to teach you today how to speak like a CFO, how to build a better business case, understand some of the frameworks that CFOs are using to, evaluate the various things that are coming across their desk. So we got a lot to cover. Of course, all the Ethicsverse members, it's free, by the way, if you haven't heard, all the Ethicsverse members are going to get these slides. And let's dive in. So last time we talked about understanding the business that you're in. We talked about different revenue models. Today, we're going to be talking about speaking the language of business. Next session, we're going to talk about connecting compliance to strategy. Then we're going to talk about navigating the revenue engine. This is going to be kind of sales and marketing focused. Then we're going to be talking about engaging technology and operations. And finally, in this first sort of chunk of courses, we're going to talk about leading with influence, culture, and business metrics. So the chat is already blowing up. Great to see you guys all here. Before we jump in, just a quick spotlight on a tool that lives this philosophy. We talked about this a little bit, but we try to build into our software tools that help you demonstrate the things that we're going to be talking about today. So our analytics and executive reporting dashboard and tool is built directly into the case management system. So you can leverage that to tell a better story. So much of what we're talking about and communicating with the business, speaking the language of the business, of course, we have to have the words right. We have to have the right lexicon. But it really comes down to storytelling, to put people that are not familiar with what we're doing in the picture and to better understand what we're dealing with so that we can get their endorsement and so forth. So let's say, close your eyes, your CEO comes up to you and says, what's the ROI of your compliance program? Show your work. Let's let that question sit for a sec. When can you answer this right now? Can you answer it with numbers? And can you answer it in a way that's going to satisfy a CFO? Most of the compliance folks that I speak with can't. And we're going to be fixing that today. So we're not throwing stones here. We're not throwing eggs at each other here. It's just an observation of a gap that exists in our market or in our industry that is very closable. Okay, so we're going to be working on closing that today. So here's what most compliance people knee-jerk, instinctively respond with. We talk about training completion rates. Look, we did all this training. Look at all the cases that we closed last year. Look at how successful our Speak Up program was. Look at all the reports we got. Our hotline's available 24/7. These are all metrics that kind of indicate how the health of our program or the health of our department, but don't really speak to that to the ROI. So tracking these things, of course, is important, but what the executive team cares about is how is this helping move our business forward, okay? So when we answer with those kinds of compliance department-centric metrics, what it ends up conveying to the CEO is this is somebody that doesn't know how to answer my questions in business terms, okay? So the good news is that, like I said, this is a learnable skill. We're going to be talking about some of these frameworks over the Ethicsverse MBA so that you can feel more confident speaking the language of business. And the good news is that once you see how to reframe some of your initiatives in terms that are going to resonate more, once you learn these frameworks, you can't unlearn them. So this is just going to add yet another tool to your tool box, okay, your tool set, whatever you want to call it. Okay, so we are going to start with the real basics. We're going to start with these foundational 3 financial statements that every single business runs on. You guys have heard about these things. These are the things that CFOs sew together to make little blankets that they sleep under every single night. You don't need a CPA, you don't need a CFA, you don't need an MBA to understand these things. You need about 20 minutes or so of willingness to look at these things. And once you understand how they flow together, you're going to start to apply your natural risk lens and see where some of the risk lies, okay? So these are the 3 reports that every single business runs on. You have your income statement, your balance sheet, and your cash flow statement. And all of these things flow together. So your income statement is how much did we make? How much, this is what we call a flow statement. How much flowed through our business? How much flowed into the business from a revenue standpoint? How much flowed out of the business over some time period from an expense perspective, and what was left over at the end? The balance sheet, this is what you own. So think about this as a snapshot. This is a stock statement. So if you pause, we're moving through time. If you pause real quick, take a snapshot of all your assets, liabilities, and equity at a single point in time. That's your balance sheet. And then your cash flow statement is kind of how did all the cash flow through the business? Every business exists to generate cash, ultimately to generate returns for the investors. And so the cash flow statement shows how over the time period given, how did cash change and where did it go? So I put together this financial statement interaction visual workflow here so you can see how all these 3 statements connect. So again, you don't need to be a CPA to understand this, but let's start with our income statement. We have our revenue. We talked about revenue models last week. We have our cost of goods sold. Those are the things that bring us down to our gross margin like we talked about. Then we have all of our operating expenses, our salaries, our rent, our marketing, our sales expenses, and things like that. What's left over is our net income. That net income flows directly into our balance sheet. It flows, the cash component of it flows into the cash flow statement, and whatever is left over on a net income basis flows into the equity. Now, the change in cash over the time period is captured on the cash flow statement. So the cash flow statement says we started with this much cash, we ended with this much cash. There were all of these ins and outs, and all these ins and outs fall into three major categories. So we have our operating activities. These are the normal things that in the normal course of business that affect how cash changes. So cash from our core business activities, the revenue that's coming in, the cash that's coming in the door, the cash that's going out the door. Then we have the second bucket of things on the cash flow statement, which are called our investing activities. So let's say we bought a new plant, or we bought a new machine, or we invested a bunch of money into some software. We made some kind of an investment in the business. Those are captured. Those are dollars that go out the door that might not show up on the income statement, right? If you buy a new piece of equipment that costs $5 million, that's not an expense in a given year. That gets depreciated. We talked about this a little bit last week or last session. This gets depreciated over time. And so the expense connected to that investment gets recognized over time through the income statement. It's not all up at once. So any of those investments, though, as that cash goes out the door, as that $5 million goes out the door, is captured in the investing activities. And then we finally have our financing activities. So these are things like loans. This is us issuing stock. If we get a loan, all that cash lands on our balance sheet. That's not income. That's not revenue that's going to show up on our income statement, but that does change our cash balance. So again, our balance sheet is that snapshot. The income statement is this flow statement that shows everything that sort of flowed through the business over the year. And then the cash flow statement gives us a picture of how the cash levels change throughout the year. Okay, so why is it important for compliance professionals to be financially literate? Well, I think first of all, financial data is where a lot of risk hides. Once you start to spend, once you feel a little bit more comfortable with the financial statements and you can start to look at them, you can see that each of these financial statements, or any financial statements that you're comparing from different companies or from different time periods within your organization, they all tell a story. So whether there's aggressive revenue recognition, if there's unusual expense patterns. We had an example in the last session about some changes we saw in expenses relative to revenue, and those gave us hints as to questions we need to ask to better understand the story behind the numbers. All of these things, off-balance sheet transactions, aggressive revenue recognition, are all captured on the financial statements if you know where to look. I think the second reason that this is important is that every compliance initiative requires funding, right? So we need more heads, we need more tools. This funding requires credible business case that's written in financial terms. All the executive folks that you're talking to, whether it's the CFO or the CEO, they speak this sort of financial language, and we need to be fluent in that language if we're able to communicate in a way that's compelling and that resonates with them. And I think finally, probably most practically, the people that control your budget speak this language. And so again, when you can speak that same language, a lot of these doors are going to open up. But if you can't speak the language, and a lot of us have felt the same frustration, we're going to be at this disadvantage when it comes to these resource conversations. We're going to be talking about completion rates when they're talking about ROI. All right. So let's talk about this 80-20 rule for financial literacy. Already almost up to 1,000 emojis. I mean, this is amazing. I really do love these sessions. I feel like we're having a great impact here with this. And so as we continue to go through the Ethicsverse MBA, if there's other topics that you feel like you'd like some more knowledge on, drop those in the chat, and we're going to continue to build out this curriculum. So let's talk about the income statement and how to read this like a pro. So we touched on this a little bit last time, but this is our income statement decoded. For any of you that missed it, you can find the replay on YouTube. Round of applause for the one and only Chase. He keeps that YouTube updated every single week, okay? So our revenue, this is like what our customers paid us. This is our compensation for the services or the goods that we have provided out to the market. Our cost of goods sold is what it's cost us to deliver those services or to deliver those products to the market. That brings us down to our gross profit. That's the spread. That is the cash that's available for operating activities below the cost of goods sold, those variable costs that correspond with the revenue. So we have our gross profit, and then below that, this is where all of our operating expenses are. So this is where the ethics and compliance, or the HR or sales or marketing, all those different departments, those ongoing expenses that are not influenced directly or in the short term by changes in revenue, that's where all those expenses live. That's where your line item lives. Okay, that brings us down to our operating income. Then we have some non-operating expenses usually that bring us down to our net income. So revenue recognition is a critical component, a critical topic that you should at least understand, okay? It's one of the most important concepts that we can at least be able to conceptualize when we're doing our job. So you don't need to go through, FASB and GAAP and all that stuff. You just need to understand at a high level the importance of revenue recognition and where some of the risk can lie when an organization gets too aggressive with the revenue recognition. So these are ultimately rules around when a sale becomes revenue. And these are there's strict guidelines under SASC 606, I think, and IFRS 15. But see, companies under pressure tend to push the limits on this a bit, and sometimes they can get very creative. So there's a classic example that we've all heard of, cautionary tale, which is Enron. So they were booking expected future revenue as current income. As your income goes up, there's more accounting profitability that translates into a higher stock price and so forth. So the basis for a lot of the Ponzi scheme that was Enron was pulling forward revenue that they haven't earned yet. So this divergence is where fraud begins. And so if you can think about revenue recognition, the rule is you can only recognize revenue when it's earned. So you are likely paying for some software for something, right? You're paying maybe annual in advance for the usage of some software over the next year. Well, that software company that's receiving that annual payment upfront, they can't recognize all of that revenue until the services are provided. So you're paying, $12,000 for a piece of software. Well, each year or each month in that year that payment corresponds to is where $1,000 of that $12,000 can be recognized from the company's perspective. So you need to ask yourself or think about, are we getting payments early? And if those payments are coming early, is the recognition, when recognition just means when we can, claim that on our financial statements, is that recognition corresponding to when that service or when that good is delivered? Okay. Let's talk about operating leverage. So this is a broad concept that a lot of us maybe haven't heard of, or we don't think about this way, but directly affects your budget. So when a company has high operating leverage, it means a lot of their core operations or their core costs are fixed. So when revenue drops even a little, there's an enormous amount of pressure on every single remaining dollar. So compliance budgets are particularly vulnerable due to this operating leverage concept, because they're often categorized as discretionary rather than essential, or certain aspects of a program are categorized, at least in the minds of executives, as discretionary rather than essential. So if you can understand the picture of your company's operating leverage, you can better kind of anticipate when those budget pressures are going to be coming and better prepare your defense before that conversation starts. If you're just kind of finding out about this concept as you're having that tough conversation with your CFO, you're in a much weaker position than otherwise you could be in if you're, kind of anticipating it. So think about this operating leverage as this just has a direct influence on the proportion of dollars that fall to the bottom line due to that base of fixed expenses. So because we live in that fixed cost, that fixed operating cost, and it's sometimes harder for us to connect the costs that are attributable to our department to the ultimate profitability to that bottom line, we're sometimes more vulnerable for budget cuts than, say, marketing, which has a more clear, direct impact on the thing that people care about most, which is that revenue expansion. So your margin trends are going to tell a story. So you should be somewhat in tune with how margins within your business are changing. And you should be somewhat in tune with the level of operating leverage within your organization. So let's walk through this sequence because I think it tells a predictable story, okay? When margin starts shrinking, management looks for costs to cut. We've all lived through this during various business cycles. When, compliance budgets are often targeted first because they look at those as overhead versus protection. It's always, it's sometimes difficult to articulate how many, car accidents you avoided because you took a defensive driving class, right? Some of this protection is harder to quantify. Weaknesses in our controls can sometimes increase the company's risk exposure. And that increased risk exposure can ultimately lead or eventually lead to exact losses, whether those are fines, whether those are lawsuits or reputational damage. And those can sometimes come when a company sort of cuts down to bone. They cut out too many of their expenses. So this can be a real vicious cycle. And you can use this kind of a framework to argue against compliance cuts before they happen. So we have shrinking margin. The cost cutting ends up, attacking us first. These weakened controls end up increasing the risk exposure, and this risk exposure can end up leading to losses that the company is trying to avoid. So making sure that you are fluent in this kind of this flow, you know what I'm saying, this cycle, and being able to articulate that at least conceptually to the CFO or to the executive team who might be putting pressure on you to lower your costs, can let you, make a better case and kind of get into that, and avoid kind of living in that reactionary mode. If it feels like I'm going fast, I am. We got a lot of slides to get through. We have a lot of information to get to. So if you should like and subscribe, follow us on YouTube, and you can watch this replay later. And of course, if you have questions along the way, please do follow up if I'm not able to get to them in real time here, okay? So let's do something interactive here. Find 3 compliance risks living in these numbers. I want you to identify at least 3 places where compliance risks might be hiding. And I want you to think about questions like this. Is revenue growing faster than cash? Are there unusual spikes in any expense category? What are margins doing over time? The goal here is to practice our financial literacy and use that financial literacy through this compliance lens. Oh man, I'm so sorry. This slide did not upload. I'll send it around. We'll update it, but I guarantee this would have been very interactive and you would have really put the pieces together. But if you can think back to the first section, think about in our first Ethicsverse MBA, we showed those financial statements and some of those things that I just kind of alluded to. Sorry again that slide didn't upload, my fault. Some of those things we really highlighted. We saw revenue growing a little bit and we saw expenses growing a lot faster. We saw certain expense line items growing particularly faster. We saw cash not growing nearly as fast. So some of those clues, some of those changes could give us some clues as to like what might be coming down the curve or, what might be coming around the curve so that we could better position ourselves. So these are things, if you're at a public company, every quarter, your financial statements are made publicly available. If you're in a private company, having an offline conversation with your CFO and getting a look at the financial statements and seeing what's happening with the margins and thinking about how fast is revenue growing relative to our expenses. Are our margins expanding or are they contracting? Can, again, give you some hints on the conversations you want to start having earlier, okay? Okay, so let's talk a little bit about the balance sheet now. The balance sheet, again, this is what you own. These are all of your assets, all of your liabilities, and what's left over is the equity, okay? So there is a base, they say in accounting that accountants don't die, they just lose their balance, okay? So there is this base equation that allows every financial statement to balance. So all of your assets equal the sum of both your liabilities and your equity. This is the fundamental equation in accounting and the fundamental equation for the balance sheet. So again, your assets are your cash, your receivables. These are all the things that can be converted into cash over some time period. You have your short-term assets, which can be converted into cash within a 12-month period. So anything that is in your accounts receivable, these are maybe invoices that you sent out for payment from your customers that have not turned into cash yet. Those are going to live in your short-term assets. And then you have your longer-term assets, which are things like your property, plant, and equipment, your IP, things like that. These are things that are less liquid, meaning the most liquid asset is cash. Anything that is less liquid than cash, there's some kind of liquidity difference, and it takes some work to convert that into cash. So your house, for example, is an asset, but that's an illiquid asset that's not as spendable as the cash in your checking account, right? It takes some work to convert that house into cash. You have to hire a real estate agent, or maybe you can, ChatGPT. I don't know if you read that article this week. A guy sold his house in 5 days using ChatGPT. So real estate agents out there, beware. Your liabilities are the things that you owe. So these are your debt. These are lawsuits. These are regulatory obligations. These are your payables, right? You're probably, you are probably as an organization receiving invoices that are due in 30 days, or maybe they're due in 90 days. Those are obligations that you have. Those are outflows of cash that are living in your liabilities. And finally, the residual value, if you have your assets and you subtract out all of your liabilities, whatever's left over is your equity. So every line item has compliance implications if you know where to look. Okay, so where does the risk hide on your balance sheet? These are 4 areas that risk can hide, and I think understanding these are some of the areas that you in compliance are going to want to pay most close attention to. So let's talk about goodwill first and foremost. So goodwill is basically overpaying for an acquisition with hidden company issues. So goodwill inflates when a company overpays for acquisitions that have hidden compliance problems, for example. So let's say if you add up all the assets of an organization and that costs $100 million, but you pay $120 million for that company, that extra value ends up being kind of plugged into this account called goodwill. Your contingent liabilities. This is another area to understand and think about. So contingent liabilities are where, pending litigation or regulatory like actions might live. Okay. These are often buried in the footnotes of the financial statements that are coming out every quarter or every month. So if you have, for example, a lawsuit that your company is in and your company estimates that you're going to lose that lawsuit, they have to make an estimate, according to GAAP, they have to make an estimate for what that payment is going to be, and they have to recognize that liability, currently, even though the payment might be a year from now or 2 years from now. So these contingent liabilities live there. If your company receives payment before they've provided services, if somebody prepays for your company services, there's a contingent liability lives, there's a contingent liability called deferred revenue where, hey, this is cash that I've received that I haven't earned yet. I need to do something in order to recognize this cash payment that I've received as revenue. So that's a contingent liability as well. Your reserves, these are things that are set aside for various different things, right? These tell you how much the company has set aside for compliance failures and whether that amount is realistic. So any reserves for like future write-offs for certain things are going to live in these reserves. And these are very, once you kind of get into these financial statements, you'll start to see like, oh my gosh, I thought this was all sort of objective. I see all these numbers on the page, which kind of implies a certain objectivity. Once you kind of get into it, you can see all these different areas where estimates live. And those estimates allow for certain organizations, Enron, again, a great example, to kind of play some games and move numbers around those financial statements. And then finally, we have our intangible assets. So these are like intellectual property, things like that. The IP within your organization is an asset. That's something that's going to lead to cash. It's an asset that has some kind of value, and there are certain estimates that are placed on those things. So if any of these numbers change significantly quarter over quarter, it's worth looking at and kind of investigating and asking some questions about, because as these numbers on the income statement change, that's going to flow through usually into the as these values on the balance sheet change, those are going to flow through either to the cash flow statement or to the income statement. Okay. So let's talk a little bit about this acquisition trap. This is one of the most expensive compliance failures in corporate history, and it keeps happening. So a company acquires another company for some kind of a premium. Go back to my example, 120 million versus that 100 million that can be attributed to the assets. So recording this extra $20 million goes directly into goodwill on the balance sheet. Then post-acquisition due diligence reveals, let's say, some FCPA violations, or it unveils some environmental liabilities, some things that were not caught during diligence. Then that goodwill gets written down. You're saying, oh my gosh, I thought this company was worth 120 million. They've been, pouring, chemicals out the back of the plant, and now there's this massive environmental remediation that we didn't uncover during diligence. When that goodwill gets written down, that has to go somewhere. And as that asset, that goodwill plug, as that asset decreases, well, the cost of that is a loss on the income statement. So that can translate into a massive earnings hit. The CEO remembers who or who wasn't involved in that pre-acquisition review. And so the lesson here is clear. Compliance diligence before an acquisition is an investment that can save millions and millions of dollars down the road. So if you are feeling sheepish about how to pull your chair up to the grown folks table, if your company is in M&A mode, then this is a great way to kind of talk about why you deserve, some space at that table. My good friend Mel Sponholz did a great job at a previous, company that she was at by showing her value in the due diligence process in uncovering some things that turned a real light bulb on at the top, at the executive level, to where she was then brought in for every single M&A transaction. She was able to uncover, some fraud or some really aggressive revenue recognition practices in an acquisition target, and which ended up translating into a significant drop in the enterprise value that her private equity fund was going to pay for that target company. And that simple uncovering of this that saved the company, from having egg on its face from wildly overpaying for an asset, then created the circumstance for her to be involved in all those M&A transactions. So again, ethics and compliance is a risk. We have a very unique perspective. It is a risk management. It's a specialized risk management function. And when we can understand how some of these things on the financial statements move, we can really get in and add a lot of value on the front end. It's way worse, obviously. I mean, many of you have dealt with something like this, where there's an acquisition and then you get in there and you start trying to integrate and you're like, oh my gosh, why didn't anybody look at this? Those are all added costs that indicate that the company overpaid for that asset. If we can get in there sooner, we can really influence the value that the company pays for that target. Thank you so much, Mark, keeping me going here. He said, it's been a great talk so far. We're just getting started, okay? So the balance sheet question every single compliance officer should ask is, what are our contingent liabilities and what's driving them? We all have contingent liabilities. All of our companies have some kind of contingent liabilities, most likely on our balance sheet. What are those values and what's driving those? If you don't think to ask those kinds of things, the odds are if something goes wrong, you're going to be playing cleanup on the back end. So again, a lot of, a big driver behind us doing the Ethicsverse MBA is to give you the circumstances or give you the language, at least, to start stacking the deck in your favor to change your circumstances, because you have to force your way into the party, okay? You have to force yourself into that grown folks table and that conversation. And you have to know, at least in your heart of hearts, that you have value to add. You have a unique skill set. You have a unique perspective that can really save the company, a lot of money and a lot of value down the road. Okay. This is the one statement that can't lie, okay? Because you're starting with a cash flow balance at the start of the year. You're starting with a cash flow balance at the end of the year. That's totally objective, okay? You can't really fudge cash unless you're doing like blatant critical fraud, okay? So let's talk a little bit about this cash flow statement. How are we doing on time? I feel like we're moving at a pretty good clip here. Okay, so we talked about this on that flow chart that I showed you before. There's three main areas on your cash flow statement. These are actually the only three areas, okay? So we have our operating cash flow, our investing cash flow, and our financing cash flow. So our operating cash flow, these are the cash flows from our actual business operations, the main things that are happening every single day, every single month, every single year. The next section is our investing activities. This is the cash spent to grow the business. This is cash for new equipment, for a new location. If you're buying a building, that's going to live there. If you are doing an acquisition, that cash flow is going to live there. And then finally, our financing cash flows. These are cash that we're getting into the company from sales of stock, from loans we're getting from some kind of debt provider, or dividend payments. As the company is making dividend payments out for the stock that it has, floating out in the marketplace, that's considered a financing activity that's not showing up on our income statement. That's a distribution to owners. So these main three buckets are important to understand: operating, investing, and financing. Okay. And again, if you're seeing the cash dropping significantly and you're seeing revenue growing exponentially, well, then there is a chance that there can be a cash crunch at some point, and that can sometimes cause a business to make some short-term decisions that have long-reaching implications on the going concern of that kind of a company. So this is, pardon me, Compliance should love the cash flow statement. So, we talked about this a little bit. When cash flow is going the wrong direction relative to net income, that should be kind of a red flag. We should start asking some questions about that. It might be legitimate, right? We might have a large customer that's paying late, all good. But it also could indicate some earnings manipulation. It can indicate aggressive revenue recognition. It could even indicate some fraud. So you can message earnings by changing depreciation schedules, okay? You can massage earnings by changing your depreciation schedules, by adjusting reserves, right? Some of those changes on the balance sheet that end up, that are really rooted in certain estimates or certain arguments that, the finance team can make around those estimates for reserves, for depreciation, for revenue recognition timing, can end up influencing both that balance sheet, both that income statement and that cash flow statement. So if either of these arrives at a bank, either the cash arrives at our bank account or it doesn't. So this makes your cash flow statement your most reliable tool for your financial due diligence. Comparing that to what's going on the income statement is a great place to start. But again, businesses exist to generate profit for their owners. That profit, it comes in the form of cash. So that is like the lifeblood of an organization. So having some kind of intimacy or some kind of familiarity with the cash position of your company can give you some hints, again, at where you should direct your limited resources and your limited time to making sure that your business is being de-risked and can be around for a long time, continue to flourish, and so forth. So when cash flow and income tell different stories, you need to start asking questions. All right, so let's now dive into the CFO's head. We're at 2,600 emojis. This is like one of my best days ever. I'm feeling super fired up. Oh, I saw a question here from Fazal. Hold on here. Aren't lawsuits and their possible outcomes off balance sheet items sometimes called contingent liabilities? Well, technically it would be on balance sheet. And there's some kind of a contingent liability that's recognized in real time. Those ultimately get recognized. There's some estimate for those. There's a lot of accounting literature on these contingent liabilities and what it takes, what should go into the estimates that support those values on the balance sheet. Thank you for that question. Keep those coming. All right, inside the CFO's head. So what are the CFO's mental models? This is going to be very valuable for you. You guys are going to love this next section here. So every time you come to your CFO with some ask, they automatically run this algorithm in their head and they're asking these 4 questions. What does this cost? What's the return on this spend? When are we going to see that return? And what happens if we don't do it? Think about how the CFO thinks. The CFO is a cash management, being at the end of the day, okay? They want to make sure that the financial statements are clearly presented and that the engine doesn't lock up. You know how if you don't have enough oil in the engine will just lock up and start overheating? Well, engine oil to an engine is what cash is to a business. So they're constantly thinking about these 4 questions. What does it cost? What's the return? When am I going to see the return? You want to spend these dollars and these are going to translate into more dollars down the road. When are these more dollars down the road going to be able to be realized by our organization? And what happens if we don't make this investment? All right. So these are 4 financial statement or 4 CFO style concepts that I want to kind of dive into right now. You've all probably heard about these things, but just getting a little bit more familiar with these concepts, what's behind them, what they try to convey can help us better, communicate our budget ask or our initiative in terms that our adversary, the CFO, is thinking about, or ways that the CFO is going to be thinking about these decisions, and also help us understand how they might be looking at, or what mental models they might be looking at in order to sift through these decisions. So we're going to talk about IRR, that's the internal rate of return. We're going to talk about NPV, that's net present value. We're going to talk about payback period. How long does something take to pay back? And then what is the opportunity cost? Okay, so you don't need to calculate these yourself, but I think understanding that your CFO is running these calculations in their mind with every request, including yours, is going to be very helpful in informing how you should present those requests, okay? Our CFO speaks EBITDA. How does that fit in? Great question. So EBITDA is essentially the the bottom line. Okay, we think of like, well, what's the bottom line? That's net income. Really, the bottom line is more like EBITDA or EBITDA, depending on how pretentious you want to be. EBITDA is a better proxy for cash flow than is net income. Net income is burdened by many non-cash charges like depreciation. If I bought a plant, or let's say I bought a $5 million machine a few years ago, and I can depreciate $1 million per year, which means I can recognize $1 million per year of expense in my income statement. Well, that's not a cash expense in period. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. These are certain charges, certain expenses that are either non-cash or a function of the financing methodology or the type of business it is. If it's a corporate, if it's a C Corp, C Corps get taxed as its own entity. If it's an LLC, if your company is an LLC, that LLC is not paying tax directly. That's what's called a pass-through organization. So all the earnings and all the expenses and all the the bottom line of that company ends up getting passed through to those owners. So EBITDA attempts to remove some of these idiosyncratic financing or company type decisions to get to a number that's closer to what the true cash production value of the organization is. Maybe we'll do a whole session on EBITDA, but great question. Okay, so these are the financial models. We're going to talk about IRR, NPV, payback period, and opportunity cost. We're going to demystify those things. So net present value, this is like the basis of all finance, okay? This is arguably the most important concept in corporate finance, and this is what all your friends in the finance department or all your buddies who got finance degrees spend a lot of their time learning about. The core principle is very simple. $1 today is worth more than $1 tomorrow. Well, why is that? Would you rather have $1 today or $1 a year from now? Of course, you'd rather have it today versus a year from now. This is because you could invest $1 today, or you could spend $1 today. You can invest it and generate some kind of return, or you can spend it today and get that benefit of whatever you're, kind of buying. If you have to wait a bunch of time, there's some cost to waiting. If $1 today is worth more than $1 tomorrow, well, how much is that difference? And what is that difference? Okay. So NPV takes all these future benefits of investments, the cash flow that's coming from an investment, and discounts them back to today's value and subtracts the cost. So if the resulting value, if the net present value is positive, then the investment creates value. If it's negative, then that money should be spent elsewhere. So this is how the CFO is going to look at every major decision. So let's kind of walk through this a little bit more. The whole point is, again, if $1 today is worth more than $1 tomorrow, the NPV calculation is going to account for timing. So returns next quarter are worth more than returns 3 years from now. Positive NPV, positive net present value of something is going to create value. So, I mean, what's cool about NPV is that it can be applied to any investment. If you're buying a house, you're spending some dollars on a house, you're doing upkeep on the house, those are other expenses, and then you're selling a house down the road, hopefully for a greater value. Well, NPV allows you to chart out over time what those dollars in and dollars out are, discount those back at some kind of a rate to figure out, is this a good investment or not? The same thing can be done with a stock, whether it's giving dividends or not. It's just capturing the timing of it's capturing the cash flows, the ins and outs, along with the timing of those cash flows, and bringing them all back to like present day, to time point zero, so that you can make intelligent investment decisions across different types of investment options. Okay, so here's a great NPV example for compliance. Okay, so we want to make an investment of $200,000 up front to automate our compliance monitoring. Maybe this is you found out about the Ethico new third-party AI third-party management tool. You want to spend $200K on that up front. Our year one savings are $80,000 because we've reduced a ton of manual review. Our year two savings are $90,000 because this is where our process improvements are really kicking in and it's really flowing. Year three savings, we have full full adoption across all of our departments, and then we're saving $100,000. Okay, so we spend $200,000 to get 80, 90, and 100. Is that a good investment? Well, it all comes down to the discount rate. So think about the discount rate as the company's cost of capital. This is like the hurdle rate. This is the line in the sand, right? Think about if you're changing credit cards, right? If I have a credit card over here that's charging me 20% and I can find another credit card over here that's charging me, I don't know, 15%, well, then it makes sense for me to move those dollars over to this lower lower priced credit card in most cases, depending on what those transfer fees are. So this cost of capital is just how much does it cost for our company to borrow, or what's that line in the sand, the return over which the return that we demand as an organization to make any kind of an investment. So our NPV calculations are, you can see them right down here. I'm not going to get into the math of it, but we're getting $80,000 a year from now. We're getting $90,000 2 years from now. And 3 years from now, we're getting $100,000. So when we discount those dollars back, because remember, again, a dollar today is worth more than a dollar tomorrow. That comes down to if I'm taking next year's savings back to today, that turns into $72K. 2 years from now, I'm taking those savings, I'm discounting them back to today, that turns into $74,000, right? What this is implying is that $90,000 2 years from now is equivalent to about $74,000 today, based on this 10% discount rate. The $100,000 3 years from now, pulling that back to today, is worth about $75,000. So if I can take next year's savings in today's dollars, 2 years savings, bring that back to today's dollars, 3 years saving, bring that back to today's dollars, that comes up with $222,000. So that's all of my upside. My upside is not 90 plus 80 plus 100. Okay, because that does not take into account what the time value of those dollars. So when I pull all those dollars back to today, 1 year, 2 year, 3 year, I pull all those back to today. I then compare that to what it costs me to get that return in the future. That comes up with a net present value of $22,000. So this is a positive NPV. So having this kind of a conversation with your chief compliance officer is very different than saying, "Hey, I need to get this $200,000 platform because this whole thing is a mess." Saying something more like, "Hey, I have this investment. This is a positive net present value investment because of the savings I'm going to generate over the next few years, and discounting those back at our current cost of capital. This is a no-brainer." Investment. You've now elevated yourself from this sort of office of no, person that doesn't get it, to somebody that's really speaking their language. So we could have a whole session on this. I mean, there's entire semesters that are talking about this concept. I'm just trying to give it to you at a high level so you can get a little bit familiar with the concepts that underpin this thing. Okay, so net present value. This is how you might want to use this in the future. You want to spend $500K on a third-party management platform. The CFO says, "Is it worth the investment?" Well, you're going to go through these steps. You're going to quantify the savings. You're going to estimate the impact year by year. You're going to apply some kind of a discount rate, and then you're going to show the net present value. The CFO takeaway is going to be very different than if you're just asking for an expense up front. We got to cut the steak up for these little CFO babies. We have to make them bite-sized pieces for them to be able to digest it. And if you can start doing that yourself, you're going to elevate yourself, and you're going to make it a lot easier for them, because you're anticipating those four questions. You're going to make it a lot easier for them to give you the yes that you're looking for. So how do you quantify the savings? Well, we know we're going to have lower screening time. We know we're going to have less incidents. We know we're going to have lower remediation costs. We're going to make conservative estimates about those things. We're going to estimate those year over year. Just do it over the next 3 years. We come up with $250,000 of risk reduction and efficiency. We use our cost of capital. A company's cost of capital is usually somewhere between 8 and 12%. Sometimes it's a little bit higher. Sometimes it's a little bit lower. You can get that from the CFO himself, or you can make a conservative estimate for that. And then we're going to compare those savings relative to those dollars. If the NPV is positive, you now should have a lot of confidence going into that conversation because you've done the math. This is not you doing Kentucky windage and just kind of guessing or, arguing from, the conditional tense of should. You're arguing with dollars and cents. And those are the things that CFOs, they start salivating about. Okay, let's talk about IRR. So IRR is the companion to net present value. If the the net present value is positive, the IRR is going to be positive. So net present value tells you the dollar value of what you created. IRR tells you what the dollar returns are. Okay, so you can speak in IRR or you can speak in NPV. Those are companions, those are brothers, or whatever you want to call it. One is speaking about the percentage, one is speaking about those dollars. So think of it like this. If someone told you you had a savings account that paid you 22% interest, you'd immediately know that this is an excellent savings account, okay? IRR does the same thing for any investment. The hurdle rate is the key comparison point. So if I have a 22% return and a 22% internal rate of return for a particular investment, the CFO is automatically going to be comparing that to like, well, what's my cost of capital? If I have a 22% return and I'm only paying a 10% cost of capital, if we did the NPV calculation, that NPV would be a positive value, okay? So every company has a cost of capital, even if they don't publicize it. So this is the minimum return the company requires to approve an investment. Okay, if it's cost me 10% to borrow from a bank, I don't want to put that into investments that are only going to yield me 10%. If it costs me 10% from a bank, I want to put those dollars from that loan, because I got to pay 10% for those dollars. I want those dollars to earn something beyond that 10%. So that's that cost of capital. That is that hurdle rate. So you can ask your finance team what that cost of capital is to get some sense of like what that line in the sand is. And then you can craft your argument. Again, let's use conservative estimates here as we project into the future, but that'll give us a nice line in the sand that we know that we're going to have to exceed if the odds of us getting the yes we're looking for are going to be higher. This single number tells you exactly what your compliance investments need to clear in order to get a yes. If you're again, put it this way, if your cost of capital is 12% and you're constantly coming in with, budget asks that seem like, because they haven't done the math, they don't know the nuance of your business, they don't know the savings that are going to come, they don't know the risk of the penalties that you're going to avoid, that seem to be below that number, they're going to be dismissing those out of hand, okay? So the simple version of IRR is this is your investment's interest rate. Like the checking account gives you 22% in my example. This is the interest rate that this investment is going to generate for the organization. Compare the IRR to the hurdle rate. If the IRR for the investment that you're coming up or for your budget ask is above it, you've now stacked the deck in your favor to get that yes. So companies set a minimum return threshold, like I said, somewhere in that 8 to 15, 8 to 12 range. And we want projects that generate an IRR beyond that. Otherwise, the company is, at the end of the day, from a finance 101 perspective, losing money. Higher IRR, better investment. CFOs love IRR because this is the single percentage. CFOs are getting bombarded all the time. Hey, let's get this. Hey, I need more heads. Hey, my budget needs to expand. Hey, we should go ahead and spend some money on this. These are all different types of investment. These are different types of projects. So these concepts like NPV and IRR allow a CFO to boil those things down to like a bottom line type number that allows them to compare across these diverse options. So IRR in action. A training platform that costs $100K. We have $40K of savings in year one, $45K of savings in year two, $50K of savings in year three. We do the math on that. Our IRR is 18%. That's well above. That's almost double the company's internal, their cost of capital. That internal hurdle rate. That's a very easy answer to say yes. Same kind of thing with a monitoring tool. If we have an IRR of 14% and we're beating that by 4%, we have an IRR of 14% and we have a cost of capital of 10% or an internal hurdle rate of 10%. Again, this is a positive investment from a corporate finance perspective. So both exceed their hurdle rate, but in these two examples, A is on a bottom line basis a better investment because the IRR is higher. It exceeds that hurdle rate, that 10% hurdle rate, by a greater degree. So what that tells you is that that's generating those returns faster, or it's generating a greater magnitude of those dollars faster. Option A does. How do you guys like this? This is great, right? Okay. IRR. So the CFO says we have $300K to invest. Why should compliance get any of it instead of it going to sales or instead of it going to the engineering department? So this is where we're talking about a little bit of science. This is going to be the art, okay? For us to be effective at ethics and compliance, it's always this mix of art and science. It's always this collision of these two sort of sides of the house. So we want to make sure that we're framing things right. Frame compliance as competing for capital. Your project is evaluated against every other investment that the company could make. Calculate your program's IRR, or calculate your project's IRR. Estimate the annual risk reduction. Again, we want to do this conservative. We don't want the CFO to throw up all over it when they start to see those details. We need to be conservative with our estimates. But if you've come to any of our ROI sessions in the past, we can always be extremely conservative and still come up with a great answer, because the impact that ethics and compliance has on a business is there. Like, it is. It professionalizes the organization. It de-risks the organization. It then just becomes incumbent on us to make conservative estimates on where those risk reductions, or where that professionalization, that lowering of operational volatility occurs, and start to quantify those things. So we want to compare those things favorably. Our compliance automation project has an IRR of 22%, which greatly exceeds our company's hurdle rate of 10%, and is competitive with top tier capital projects this year. It's a very different conversation than saying, hey, can I please, can I have a minute of your time? Can I get an extra head? We have to be able to speak the language of business. We have to be confident in those kinds of conversations. And we need to have done our work on the back end to back those things up and justify the thing that we're asking for. All the better if you can justify that in terms and in frameworks that the CFO or the executive team is naturally going to be looking at due to their position and due to their concentration. Naturally, if they're looking at it in those frameworks, and we have built our argument or built our case using those same frameworks, we're going to be able to thread that needle a lot better. You don't need exact math. This is something that I always get caught up in. I've done this ROI, these various different sort of flavors of these ROI discussions multiple times at multiple conferences. And the number one objection that I keep hearing is like, well, how do I make these estimates? I'm sure I'm going to run long today. I'm already at an hour. Okay, so check the replay, okay? Like and subscribe. You don't need exact math. Even if it's a rough IRR estimate, it's going to show the financial sophistication that you're bringing to the conversation. Most compliance teams lack this. Most compliance teams are scared to even bring some of these concepts into the conversation. You don't need to be a freaking PhD in finance in order to start talking about IRR or talking about net present value. You can ask your finance team or some AI to help you calculate the IRR. And think about the two layers of this kind of conversation. Think about the two layers of strategy in this conversation. Just having the conversation, you're going to get an answer that is absolutely a net benefit to you and to your initiative, because now you know what the line in the sand is. But there's another layer to the conversation, that you are showing up as somebody who wants to understand the business and wants to understand how they're looking at the business. Just asking the question elevates you in the eyes of the finance team. Okay, payback period. This one is probably the easiest out of the things that we're talking about. This does not take into account the time value of money. Remember, the time value of money, simply stated, is that $1 today is worth more than $1 tomorrow. The payback period doesn't take that into account at all. So it's the simplest financial metric. How long until this investment pays for itself? With ignoring the timing of those cash flows. Okay, It's denominated, though, in days and years. It's denominated in some kind of a, time period, okay? So there's a rule of thumb around payback period of 2 to 3 years. If your investment can pay for itself within 2 to 3 years, that's usually a good operational investment. So capital intensive projects like factories, they might naturally be a little bit longer, 5 to 7 years. You're putting out a bunch of dollars to build a new factory. You're putting out a bunch of dollars to get a new machine. Well, that machine should hopefully pay for itself That investment should ultimately be justified over some time period that's less than 100 years from now or something like that, okay? So why CFOs care about payback period? Because it talks about cash flow certainty. Liquidity matters. Think back to my example about engine oil and how lack of engine oil can lock up an engine. Lack of cash can lock up a business. They care about this from a risk reduction perspective. The further out that returns are, if I'm saying, hey, I'm going to make this investment and it's going to pay back, it's going to pay for itself in 15 years, that's not as good as if it's going to pay for itself in 5 years, right? So the rule of thumb, payback period within 2 to 3 years for operational investments is what you want to be shooting for in framing your ask in, okay? So here's a payback period example. So you want to invest $150,000 in a new policy management platform, okay? The investment is $150K upfront. we're going to be in year one saving $50,000 because we have reduced admin time. There's fewer missed attestations, a lot less kind of follow-up because we've automated a lot of that. So we got $50K next year. 2 years from now, we're going to save $60,000 because of the process automation. Our audit prep is going to be reducing. Again, these are just estimates that we're making about time savings that are going to occur in the future. In year three, we're going to save 70%. We have a full ROI at that case. The roots of this system have sort of taken root. The roots have taken root inside the organization, and we have lower compliance incidents. Oh my gosh, I'll have a whole session on how I hate how people say incidences, and yet I just did it. Imagine. Okay, so our cumulative year one, we have $50,000 that we've recouped. We spent $150 in year one. We recoup $50 in year two. We recoup a total of $110,000 in year three. So by the end of year two, we've recouped 73% of that total $150 that we spent. So if you add all this up, the 50, this is just the quick math of it, okay? It's the 50 plus the 60, that's 110. Divide it, and then we're adding another 70. And then we're dividing that by our total investment, okay? So our payback period is well within our 3 years. It's a 2.5 year payback period. And in 2.5 years, we have recouped our entire investment, okay? So again, in 1 year, we recouped a third of it. In the next year, we recouped another 40%. Payback period is asking, at what point, how many years into this investment will we have generated $150,000 that it cost us to do this investment? Okay, that's kind of the gist of this thing. So this is the fastest way to have that budget conversations. Your VP is going to ask, when will we see the return on investment? So we want to lead with our payback number. It's an intuitive metric. Everybody understands it. Hey, this is going to pay for itself in 18 months. I'm going to spend these dollars, and within 18 months or within 24 months or within 12 months, those dollars will be recouped, okay? This just gives them a sense of how long it's going to take for us to see the benefit and start living in the upside. Once that $150,000 of savings is generated, now every additional dollar is a positive return, okay? You can show that cumulative math. Just create a simple table. This is my investment on day 0. This is my year 1 savings, my year 2 savings, my year 3 savings, and just add up those savings year after year to start coming up with that cumulative total. This makes it also very easy to compare it to alternatives, and you can address the after period. Again, I just kind of alluded to this, but after we hit that payback number, in our last example, it was 2.6 years. After that payback period, it's going to generate an extra $60,000 of return, and that's when I stopped kind of calculating. If we continue with it beyond that, obviously it's going to be a lot higher. Every month we delay this. So this is also what's great. I love this kind of a line. Once you've done some of this work on your own, you can use your AI buddy, or you can use your finance buddy, or if your spouse is a finance nerd, they can help you come up with these numbers. But once you've done this work on your own, you've done this pre-work, you can come to the conversation and say lines like this. Every month we delay this decision costs us $5K in savings we're not capturing. It's a very different way to talk about the investments that we as compliance want to make for our program, which we know our organization needs. Okay, finally, opportunity cost. Opportunity cost, this is the value of what you give up when you choose one option over another. If you're trying to decide to go to the movie theater or go out for sushi, and you decide the movie theater, your opportunity cost is sushi, okay? Or vice versa. So this is what you give up when you choose one option over another. Every dollar spent on compliance is a dollar not spent on engineering, on a sales, on a new salesman, on a new marketing campaign. Understanding that your CFO is going to be thinking about opportunity cost can allow you to anticipate some of the objections you might have or you might face. So let's keep it moving here. Okay, so this third point on the right side is important. It's not about affordability. A company can afford your budget. You know, I talk about this all the time. The dollars we're asking for are not big dollars, but they're always thinking from this opportunity cost perspective. They're saying, well, yeah, I can brush these crumbs off the table for these guys, but what if I brush them off over here for marketing? Is that going to generate me a better return? So when we can anticipate that, we again can better frame our arguments and frame our case and frame our ask for more budget. This is saying this is why we need it for compliance isn't enough. You must prove your investment beats out other alternatives. So opportunity cost is a two-way street. We're going to talk about this from the cost of investing in compliance and the cost of not investing in compliance. $500K that can't be spent on development, engineering resources, new tooling, things like that, speed to market. These are the real kind of costs your CFO is weighing against. The cost of not investing in compliance is $10 million of average regulatory fines in your industry, 18 months of management distraction during an investigation. Should the DOJ come knocking, there's a bunch of disruption that's going to come from trying to meet those requests and meet those kinds of demands. There's lost enterprise customers who require certain certifications or a certain quality of professionalism, whether that's SOC 2 or other kind of certifications, operational certifications. So the opportunity cost of not investing in compliance always draws, it always dwarfs the cost of investing. Let me read that again. The opportunity cost of not investing in compliance almost always dwarfs the cost of investing. But you have to make that comparison explicit. They're not thinking about the operational disruption during a deferred prosecution agreement when they say no to a tool that you need to curtail risk inside of your operation. You have to cut the steak up into tiny pieces for those little babies. All right. If you can think, though, in opportunity costs, you can reframe every single budget conversation. The CFO is going to say, well, we could use this $300K to hire a bunch more sales reps, as opposed to generating, to investing in your compliance project. You have to acknowledge that trade-off. Yeah, you're right. $300,000 is 3 sales reps generating maybe $300,000 each per year, $900,000 in total revenue. But then you have to quantify your side. But our top 5 enterprise prospects require X, Y, and Z in order to close. That's $4.2 million of pipeline we can't convert without this investment. You've now totally flipped this. You've now, let the scales fall away from the eyes of the CFO, and now they can look at this within the proper frame. Usually compliance people are so high conscientious. They're not like nation building. They're not like just trying to gather more land. The things that we're asking for are things that we need. And the things that get taken away from us when there are budget cuts are usually things that have long-standing, far-reaching implications across the business and across our operation. So we need to be able to come to these conversations with the right frames and with the right language in order to speak their language and let them increase the velocity of them seeing things the right way, which is our way. All right. Show the asymmetry. In this example, we're saying, okay, well, we're trading off $4.2 million of active pipeline that we've already spent a bunch of dollars on to get those opportunities in the pipeline to hire 3 salespeople. We all know how salespeople are. 3 salespeople. Who knows if they're even going to work out? So I have a guaranteed extra $1.8 million from a conservative perspective on this investment versus doing, the salesperson route. Never let your investment be compared to zero. That's if you take away one thing from this, for those of you who are staying for bonus points and staying past the end of class here, never let these investments be compared to zero. So many times we go into these conversations, and because we haven't done the pre-work or we haven't done the right framing, ostensibly, the thing we're asking to is being compared to zero. And any number that's negative is, worse than zero. It's lower than zero. Always compare it to the total cost of the alternative, which is doing nothing. If we do nothing, we're going to lose these 4.2. If we do nothing, even if we get 10% of our industry, average of regulatory fines, that's still $1.8 million. That's 4 times what I'm asking for right now. We have to control the frame. We have to control what they're anchored to and what they're ostensibly comparing our investment to. And if we're not introducing that into the conversation, they're going to compare it to zero. And then anything we ask for is just viewed as more cost. It's a very important point. Okay, so let's put it together. Our $500,000 budget request, we have a net present value of about $90,000. We have an IRR of 22%. We have a payback period of a little over 2 years, and we have an opportunity cost of $4.2 million. Very, very different conversation if we're incorporating even 2 out of these 4 things into our budget ask. I know that went a little bit long there, but I feel like that was really good, if I do say so myself, okay? So this is how we can bring all of these four concepts. If we did this pre-work before we had the conversation, this $500,000 investment has an NPV of $90,000. It generates about a 20% return and pays for itself in about 2 years, while projecting $4.2 million of revenue. The opportunity cost alone of not doing this is 8x the investment. Cool. Where do I sign? Cool. Do you take credit cards? That's the kind of response we want to get from the CFO. So compliance is an investment with quantifiable returns. We just have to do the work to do that quantification. Most compliance teams never frame their budget asks in these kinds of ways. And in doing that, they end up clipping their own wings. And in not doing that, they lose an opportunity to elevate themselves as the business person that is going to get more credibility, build more trust, get a yes a lot easier. All right, so the cost of not investing. So here's another way to think about the cost of not making an investment. Again, so we've talked about some of these concepts. We've talked about where we need to plug in these estimates, right? These frameworks: net present value, internal rate of return, opportunity cost, payback period. That's where our investments live as we come to those kind of answers that we're going to incorporate. But how do we come up with, the values that end up getting plugged into those different frames? Well, we have to make estimates. Like I said earlier, you have to feel comfortable making, estimates. Every single investment in the future is based on some kind of an estimate, right? Whether it's an M&A transaction, whether it's a marketing, whether it's a marketing initiative, whether it's a stock that you're buying, there's some estimate being made about what's going to happen in the future. If we're not comfortable thinking about the future and making conservative estimates on those kinds of values, then we're stacking the deck against us. So fines, remediation, legal fees, lost revenue, reputational damage. These are the true costs of non-compliance. We have to make estimates around those things. We can find averages in our industry. We can look back over the last several years within our own company and take some portion of that, right? If every year there's a certain amount of regulatory fines that are occurring and our initiative is going to help address that, don't take credit for all of those. Take credit for 10% of them and see how that ends up feeding into your NPV calculation or feeding into your ROI calculation. Each element is quantifiable with estimates, asterisks, but most compliance teams are just kind of talking about that upfront cost. I need to hire another person. And they're like, you already got a bunch of people. I don't even know what you guys do over in that department. We need to make it easy for them to say yes. When we can, in a credible way, add up all those expenses, all those costs of an action or all those opportunity costs, then usually the thing we're asking for is way smaller than those numbers, which makes it easier to get to yes. So when you need $200,000 for a third-party risk management, your CFO hears expense. When you say it's a $200,000 investment that reduces our exposure by $5 million, the CFO hears smart, or they hear, okay, well, this person is at least thinking about these things right. And again, you don't know all the different compliance people, all the different, a lot of people have bad experiences with compliance people. Our industry has a reputation that's been accumulated for 20 years due to a bunch of interactions. You don't know what kind of assumptions the CFO is making about you. Make it easy for them. Be that pattern interrupt, break the pattern, and give them something they don't expect. I guarantee you it's going to stick out in their mind, and it's going to strengthen your position in the organization. Okay, I was supposed to be at 30 minutes at this point. Hello. I will be a better professor at some point, believe me. Okay. So let's talk about what actually gets funded. So this is the anatomy of a winning business case. There's a problem statement. There's a cost of an action statement. There is a proposed solution. There is an investment required. What is the total cost of ownership? There's an expected return / risk reduction in financial terms. This is the benefit that we're going to get. And it's ultimately the ask, a specific time-bound actionable thing. Bonus points if you put a recommendation. Bonus points if you do the rule of three, where you say A, B, and C. I recommend we do B because of X, Y, and Z. This is the kind of statement that a CFO is looking for, that an executive team is looking for, because it has all the information they need to make that decision. It's been cut up into bite-sized pieces. It's bulleted. It's easy to digest. And there's enough objective math on that page for them to understand. And, you control the frame. This is what I'm trying to talk about. We control the frame on how we show up. You control the frame of these conversations. It's right there for you if you want it. You just have to, grab the reins and kind of steer this train of horses in the way that you want. So here's a bad example versus a good example. 5,000 emojis. All I need is 2 hours. That's it. Problem statement, good versus bad. Here's a really weak, bad problem statement. We need to comply with the new regulation. The regulation requires that we implement new controls. We could face penalties, we could face penalties for noncompliance. A good statement says a new regulation exposes us to $10 million of fines and applies to 60% of our customer base. Whoa, what's that? $10 million? That's a big number. Without action by Q3, we risk enforcement that could delay our product launch. Whoa, the product launch that I'm hinging my whole career on, this is all happening in the CEO's head. Wait, the thing that I talked about at the beginning of the year, that was going to be the thing that's going to make our year, you mean that's in jeopardy? Keep going, I'm listening. 3 of our peer companies were fined an average of $8 million last year for this exact gap. Wait a minute, our competitors we're already dealing with this? Okay, please keep going. We have to frame this stuff in ways that are going to be resonant with our audience, okay? So much of our job is persuasion. Of course, we need to know the regulations. Of course, we need to not have a paper program where our policies just live in dead documents on the shelf. We need to bring life to this thing and connect ourselves to the initiatives of the business by speaking the language of the business and talking about the things that they care about in a way that they can understand or in a way that they think about it, okay? That's the basis of this entire session today. We talked about this a little bit. How do we quantify the cost of an action? We can just make an estimate for the probability of it occurring, and then we make an estimate for the impact. That's the expected loss. This is the basic framework that we're going to be using when we're talking about the cost of an action. We're going to use enforcement data from peer companies to estimate the probability. We're going to look historically, whether it's within our own organization, across the entire economy, maybe within our industry, to have some basis for the estimates that we're making. We're going to pull actual fine amounts from some regulatory sources, whether those are databases or the DOJ website. And you know your CFO is highly analytical, right? They're going to respect data, not fear. They don't think about could and should. They think about what is. And they are constantly trying to sort through all these asks for the purse strings that they control. Everybody wants to get their grubby little hands in the cookie jar, and they got to try to keep a lid on it. And they're only going to open it for the cleanest hands out there. Hopefully those are yours. So give them numbers that they can model. Be conservative in your estimates. We have a whole, hour long, maybe it's 2 hours, I don't know, 2 hour long session on ROI on where to look for points you can estimate to build a more comprehensive case. Now let's talk about framing the expected return. So you can think about your expected return across a couple of different buckets: risk reduction, efficiency gains, and revenue protection. Okay. If you remember our compliance 1.0, 2.0, 3.0 framework, these kind of map to that. Okay. So our risk reduction, we're quantifying, making estimates around the exposure, the risk exposure that we're going to reduce. Efficiency gains, probably if you're making an investment for a new tool, a new platform, a new piece of software, there's probably going to be significant time savings that your team is going to realize. You need to be able to quantify those things on a dollar basis and bring those into the conversation. Revenue protection, again, depending on what case you can make, connecting your activities or your initiatives to revenue that the company would lose without is an extremely compelling way to, back to my example, is an extremely compelling way to add more weight and add more dimensionality to your ask. Frame everything that you are asking for into what the company cares about, into what's going to add more enterprise value, what's going to add more to the bottom line, what's going to intersect with the initiatives of the CEO. That's the fastest way forward. So let's talk about a little case study here, $1 million budget request. Same program, different framing, one version fails, one succeeds, okay? So version A versus version B, okay? Version A, we lead with regulatory citations and legal requirements. We are light on numbers, heavy on compliance jargon. We're framed as a cost to the company. We're framed as something that's going to be compared to zero. There's no connection to business outcomes. Version B, we're leading with business impact. We're leading with financial exposure. We've quantified everything. We have receipts, okay? We have the basis for all the estimates that we've made. Fines, lost revenue, remediation costs. We framed this as an investment with a positive ROI. We've incorporated IRR. We've incorporated net present value. We've talked about the opportunity costs and framed that out appropriately. We've indicated from a payback period perspective that the dollars we're putting out the door, we're going to get back lickety split. We're connecting this to revenue prediction and growth. Okay, so those are some principles that we want to bring into all of our conversations. Don't lead with the regulation. They're not on the. They have no they have no like notification set up on Google when DOJ puts out a new pronouncement or some new guidance. I guarantee your CEO doesn't have that. What they care about is what's the stock price. What they care about is, am I going to hit the numbers that I told the board I was going to hit? Am I going to get my bonus this year? Connect to those business initiatives, connect to those base things that the CFO cares about or the CEO cares about, and you're going to greatly, orders of magnitude, increase the odds of you getting what you want. All right, let's talk about translating compliance into finance. Okay, I'm just rolling here, okay? We're at an hour and 20 minutes. I feel like I've just been talking for 10 minutes. Can you believe it? Let's talk about this translation guide. So we all have metrics for our program that we care about. These are the dashboards that we're looking at to make sure the trains are running on time, to make sure our engine isn't overheating, to make sure that our initiatives are, meeting our expectations. These are training completion rates. These are hotline calls. These are substantiation rates, right? The financial translations, we need to be able to translate those things into financial terms that are more applicable across, outside of our compliance laboratory or outside of our compliance department. So risk reductions per employee, early detection values, liability reduction, cost savings from efficiency gains, supply chain risk reduction. If we're not at least in the back of our mind, thinking about, well, how might I be able to articulate this in a metric? No, I'm not trying to be a jerk, but outside of the CFO doesn't care about your substantiation rate, okay? That's something that you care about because you want to make sure that your investigations are going well. They care about maybe the second or third order impacts or the implications should an issue pop up. But just giving them that substantiation rate, that's not animating to them. But we need to be thinking about, how can I connect my sort of local metrics to metrics that everybody else cares about? What are those second and third order impacts that I can drive my own sort of department-specific metrics? What can I connect those to in order to better illuminate why the things that I'm doing and that my team is doing actually matter for the organization? So let's talk about how we can calculate a couple of these. Again, we go into great depth with this. You can search ROI Toolkit, I think. Yeah, go on Google and search ROI Toolkit Ethico. And there's a whole page that has a ton of great resources there for you. We have a white paper on 20 different places to look, how to calculate 20 different impacts of a strong ethics and compliance program so that you can start playing around with making the right connection to the things that you care about, to the things that the rest of the organization cares about. All right, so training. This is a great one. Number of employees trained times average incident cost times the risk reduction percentage. Or if you're changing from, a legacy training provider that, takes a really, really long time, and in your mind, you're like, man, I really need to update and become, more modern in my training. People are complaining about how boring this is and blah, blah, blah. And that new training provider, maybe it's us, saves you a bunch of time. Well, you can very quickly quantify that. I'm spending, everybody annually is currently spending 3 years on compliance training, or 3 hours per year on compliance training. Now they're going to be spending 2 hours per year on compliance training. You can quantify based on the average cost per hour across your business times your employees times that hour. That's going to give you a number that, more likely than not, is significantly bigger than whatever the cost differential is, and even better if you're saving some money on it. Okay. So third party, I'll just do one more here. Third party due diligence, supplier risk incidents avoided times average cost per incident. That's going to equal your risk reduction. We want a before case and an after case. We need to make a conservative estimate on that differential and bring that down to dollars. Whenever we can speak in dollars, the odds of us getting what we want is always higher. And especially when we're avoiding being compared to zero, which many of us incidentally end up doing. For those of you who have questions, I'll just stay long at this point. I might just, sleep here tonight. I'll go through and try to answer some of those questions at the end. Oh, I just see one here. Can you speak to the timing of when to make these convo points? Need to get ahead of the purse string decisions. So, do you remember my favorite movie, Glengarry Glen Ross? And he writes A, B, C on the board, always be closing. I think always be compliant. Always be compliant. That's another one. A, B, C, always be closing. I would be having these kind of conversations all the time. I would be trying to create circumstances and create intersection points with the people who are decision makers and making sure that I'm showing up in front of them as a business person, as somebody who gets it, as somebody who understands what the business cares about and how I can better connect to that. That's kind of that's kind of like a macro standpoint. That's like from a macro kind of best practices perspective. I think you always need to be coalition building. You always need to be strengthening your brand within your organization and building those relationships in kind of cogent conversations with folks. So again, just create a circumstance where you can say, hey, I just learned about this new, my professor taught me about internal rate of return. I was wondering, like, what's our cost of capital? Have a 15-minute conversation with the CFO or somebody on the finance team. How do you guys think about investment decisions? I'm sure you're bombarded all the time with everybody trying to get their hand, in the purse. How do you kind of weigh these things out? And they're going to give you some kind of an answer. So that's kind of macro. On a micro level, you probably have some cadence within your organization, when budget season is coming up. Maybe it's in Q4 or maybe it's the end of Q3. Budget season is going. I'd be having conversations in, end of this quarter, middle of next quarter, and saying, hey, how are things going in the business? What's our cash position? It seems like we're hitting our goals. How are we thinking about, expansion of budgets, next year? I would be having those conversations early, and I would, again, be trying to stack the deck in my favor. Like, you are the architect of your day. You have high agency. You control your plate. If you're not setting your own plate, people are going to keep dumping stuff on it. So you have to carve out time for those important, non-urgent tasks that are really going to end up, to Tina's point, see around the curve and, smooth things out down the road. If you're having these kinds of conversations and you're showing yourself, listen, this is not like a silver bullet, but if on average you're having these kinds of conversations and you're showing yourself as somebody who, gets it, who's a business person first, then the odds of you getting blindsided by something it's just going to be a lot lower. So happy to talk offline on that. One more question here from Lisa. What if regulatory fines are not published? Is there an assumption that could be used for this calculation? I think you can always make some kind of an assumption. You can make it. You can even make an assumption about what external counsel would cost. Okay, so you can say, okay, well, this is going to be, this size of a case. You can make an estimate on like how long that case is going to take. You can multiply that out based on like what the hourly rate is for your external counsel. And you can at least bring that to the conversation and say, I'm not even talking about the regulatory fine because this is a new regulation. I mean, I would try to tie it to something. If this is anything like this issue, or if it's anything like that issue, fines for a company of our size are going to range between X and Y. You have to bring something into the conversations because otherwise those guys are flying blind. They don't know which way is up. They don't know the magnitude of what you're talking about. So we have to give them some anchor points so they can see, like, is this actually an issue if something happens here? Or is this just, a compliance person once again talking about, something that we have a really, really low likelihood of hitting? If there's a particular thing, Lisa, that you want to kind of brainstorm on, like, you can always pick the lock. There's no lock that exists in the world that can't be picked. There's no problem that we can't build a compelling case for if, in fact, compliance does add value to the organization. If the things we do actually improve the organization, de-risk the organization, professionalize the business to a greater degree, reduce the volatility of operations, well, then we can always quantify it. It's just a matter of kind of building that case. So I don't think I really answered your question, Lisa. I apologize for that. But if you want to meet offline, we can brainstorm a bit and figure out how we can make that case a little bit better. Okay, so in my experience, the compliance teams that incorporate these kinds of things into their conversations, they have a significantly higher success rate than those of us who don't. All right. So board report makeover, we usually tend to start with, of course, this is not for audit committee type of things where it's a really kind of dialed in. It's really a kind of a compliance report. I'm talking about a broader presentation to the executive team or to the board. We typically talk about hotline volume. We typically talk about training, policy update counts, attestation rates, investigation closure rates. I'm not saying those things are not important. Of course, I mean, we live and breathe these things. We have webinars every single freaking week on these topics because we think that they're important. But when we can incorporate and we can sprinkle in there, I helped a friend and a client on their board report, and he had all of these right kind of elements, and we just kind of put a little parsley on the plate. We kind of whipped up the mashed potatoes so that stuff looked a little bit better by connecting to the initiatives of the business. We talked about the things that the business cares about, and we tried to weave those things into the presentation to great effect. So what is our compliance ROI by program area? What are our estimated risk reduction dollars? What costs did we avoid by early detection? What investment efficiency ratios can we connect to our efforts, our department, and so forth? I'm not saying get rid of the things that are on the left side of your screen. I'm saying layer in these other things that are going to be better patterns for them to recognize and help them expand their view of what compliance is. We need to be adding dimensionality to our program in the minds of the decision makers inside of our organization if we're ever going to elevate our program, our department, our careers. We need to get smart on this. And there's always a way to change your slides around and say, hey, our business really cares about this. You started the year talking about Initiative A, Initiative B, and Initiative C. These are our big kind of strategic objectives for the year. Let me show you, along with these metrics, how the things that we're doing and the things that we're prioritizing are connecting directly to these, because sometimes it's not really that clear. Us kind of working in the background, sometimes it's not clear how we're kind of being a tailwind to the achievement of these kinds of things. That simple frame right there really elevates us from this bumper sticker on the car to something that actually helps us drive down the road a lot faster. Okay, so lead with dollars, not percentages. Try to show trends over time. Are we getting better? Are we getting worse? Are we as a department exhibiting a continuous improvement mode that every CEO wants everybody in their organization to be exhibiting? Connect your metrics to business outcomes. Everybody, CEOs have executive teams, everybody has OKRs at the executive level. There are statements that are put out in the annual report about what's going to happen this year. If you're at a public company, every quarter, there are usually conversations with Wall Street analysts about what's going on, what's happening in the organization, what troubles do we see, where are we going from here, what's our projection for earnings, over the next quarter, and so forth. We should be in tune with those things. Again, I'm not saying you should memorize that and be able to regurgitate all that word for word, but you should have some semblance of an idea of where the business is going so that you can start to strategize from a framing perspective how the things you're doing are connecting to those things. Make it easy to compare compliance investments from an ROI standpoint to other investments they are faced with every single year. All right. Hopefully this is the last section. I'm running out of steam here. All right, a couple more left. Everything we're talking about comes down to a mindset shift. We have to stop measuring the things that we do. We have to start measuring what we prevent. We have to start measuring and incorporating into our conversations the things that the business cares about. If we just are showing activities, that is not romantic. That's not animating. That's not something that people get excited about. If we're saying, look at how much we prevented, look at the value that this small but mighty department has had across the organization, they can start to see wow, this is really enhancing the business. This is driving a lot more engagement. Oh my gosh, I can't believe I didn't realize that we have this powerful team over here. That's on us to craft that story. It's on us to turn those light bulbs on at the top. We can't just sit back and cross our fingers and wait and say, oh, I'm working hard, I'm stressed. I'm sure they see that. I'm sure they see my value. We have to be presenting that value so that they can have the right picture about what we're doing and the impact that we're having on the organization. So remember this, if nothing else. You're not a cost center that processes regulations. You're a risk function that protects enterprise value. You are a risk function that protects enterprise value. You're not just a paper pusher. And if you can embody that and you can digest that and you can let this statement become your identity, you're going to start to see a lot of opportunities around the organization to connect things you're doing to the enterprise value that you're preserving, the revenue that you're enhancing, and the value that you're building inside of the organization. All right, so this week's exercise, okay? Those of you who left early, homework is still due, okay? Homework is still due next week. No excuse. All right, so I want you to think about rewriting your board report, or pull out the last board report you did and think about how you might have changed that given everything you learned today, okay? Take your most recent board report, rewrite one page using the frameworks from this section. From this session. Replace your activity metrics with impact metrics. Again, we don't measure what we do. We measure the value that we provide or the things that we prevent. Use the translation guide from the session. If you're an Ethicsverse Ethicutie, you're going to get this slide deck. Otherwise, you're going to have to go to YouTube and you're going to have to sort through 2 hours of rambling to get a picture of that slide. and bring both versions to session 3. I'd love to hear some feedback from you guys about this session, if it's been valuable. We're really trying to grow the Ethicsverse. I think there's so many great guests that come on every single week. The chat is phenomenal. The network, the community that we're building here is great. And there's so many people that still have not heard about it. So I am leveraging your comments and trying to spread the word about the Ethicsverse. And I would love to hear some success stories about how these sessions, particularly these Ethicsverse MBA sessions, are making your job a little bit more exciting, or little wins that you might be having inside your organization by employing some of the techniques and the frameworks that you're learning here. Okay, so one more thing, bonus move. Okay, this is bonus points. We all want straight A's. Let's lock in your straight A in this course, okay? Here's a bonus move. Email your rewritten page to the CFO and ask for 15 minutes of feedback. Hey, I'm working on presenting next time in better business terms. I want to make sure that the board and that, the people throughout the organization understand that we're working hard every single day to connect our efforts to the things that the business cares about, and not just be like some of these other compliance departments that you may have worked with in the past that are really just kind of the office of no and stuff like that. Give them the answer you want them to have. You have 15 minutes to kind of give me some feedback on this. Just put freaking NPV and put like EBITDA on there, okay? Watch their face light up. Watch the feedback that you get, and watch how you elevate inside the organization. Like, your career is yours to build. All you have to do is reach your hands up and grab the steering wheel of your career and start steering it where you want it to go. Of course, you have to do things different. Of course, you might have to learn something new, but it's right there for you to elevate. Don't let that glass ceiling, don't let the sins of people that you have replaced who didn't get business, who didn't understand your company, who were just concerned about, job security, not actually about adding value, create a stereotype that you get trapped in. You got to burst out of that thing, and you got to show up a little bit different. This is a great hack. 10,000 bonus points if you do that. All right, major takeaways from today. 3 financial statements are your Rosetta Stone for your business conversations. Coming to a CFO conversation and saying, hey, I noticed our margin changed a lot, but our cash didn't go up. I'm no CPA, but like, what's going on there? Is that something that we in compliance can help with? Your CFO evaluates compliance the same way it evaluates every other investment. Frame it that way. Don't run from that fact. Come to that conversation with the right confidence, and frame it out, right? Recognize that, hey, I'm just like every other department. I'm just like the marketing department. I'm just like engineering. I'm just like operations. And the things that I'm doing can actually move the needle because I touch things that everybody else doesn't touch. The difference between a funded program and an unfunded program is just framing. It's just the words that we use. It's just the frame that we draw around the conversation. It's just the control that we bring to that conversation to ensure or reduce the risk that we get compared. As opposed to getting compared to 0, we're getting compared to something else, okay? So it's on us to frame it. Wait till the next one, you guys. The next one is all about strategy. My favorite topic. You thought I loved accounting. Wait till you hear us talk about strategy. Strategy is not a spectator sport. That is session 3. Now you understand how your company makes money. Now you understand how to talk about it. Next, we're going to start connecting this to where the company is going and the initiatives your company is driving, the tactics and strategies that it's using in the marketplace to drive it forward. Okay, so ding, 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 bell rings. You guys can leave if you want. I'm going to try to answer some of these questions right now. Round of applause for Joe for keeping these questions going. Round of applause for Chase. He didn't even fall asleep. He's scribbling notes down. I had no idea. All right. You know what? I'll maybe answer these in like a post. I'll download these. There's too many questions here. So I'm going to download some of these questions and I'll try to answer those. I'll maybe make an article on LinkedIn and you guys can check it out there. I'm running out of breath. Love you all. Hope you enjoyed it. Come Thursday, we're going to be diving deep on the benchmark report. There's going to be a ton of tactics in there, a ton of great, really interesting things happened in 2025 that you can benchmark against. And we have the one and only Ellen Hunt, my all-time fave. So see you guys Thursday. Love you all.